Hello, everyone. In today's session, let's have a look at how should you own your assets and investments. So mainly, what's the best business structures to keep them? All right, let's have a look. Okay, just a brief introduction about myself. So my name is Brenda. I'm the principal of Impact Taxation and Financial Services. I'm a CPA and also a tax agent. Um, and I'm also one of the founding members of SMSF. So SMSF stands for Succession, Asset Protection, and Estate Planning Advisor Association. And Many years ago, in 2003, I got my Master of Commerce degree from the Sydney University, majored in accounting. And last year, I got my Master of Financial Planning degree from Griffith University. And I'm also a certified zero advisor. All right. And here is my contact details. So after the seminar, if you have any questions, you can give me a call or send me an email. All right. Before we go to the main content of the session, I just want to make sure that everyone know the information provided is for general information only. So before you make any decisions, please contact an experienced tax agent, financial planner, or one of our wealth planners. All right. Okay, let's start. So why is it so important to consider how you should own your assets or investment? Okay, so there are a few different considerations. So tax savings is one of them, asset protection, succession planning, and estate planning. Okay, let's go through more details, okay, one by one. All right, let's have a look at the tax side first. So this is actually a model we built for a couple. Okay, so we did a 10-year forecast. So based on the forecast, okay, we actually helped them with different models. Individual ownership, 90-10 split between the husband and wife, or 50-50, family trust, or company structure, or self-managed super fund. All right, and then the best case scenario is actually under family trust. Okay, so in 10 years' time, so the starting point is the same. The investment is the same, it's 100K, and the return on investment is at 8% every year. So only by keeping the investment in different structures, okay, only because of tax, in the best scenario, in a family trust situation, their wealth or investment value will be increased to 12 million, around 12 million in 10 years' time. And then the worst case scenario, individual ownership, okay, the first scenario is going to be a little bit above 6 million. So it's nearly doubled. Okay, so that's how big the impact can be, okay, for tax. Okay, in reality, cases could be more complicated. Okay, the family members' income could change. Children could grow up to be above 18, and then they can come in the family trust distribution, okay, as a beneficiary to share the income with the family, and then to help the family to reduce overall tax. All right, and then also rental properties could change from profit to loss or vice versa. So that's why we have to consider tax impact when you are considering where you want to keep your asset or investment. And then I think traditional financial planning services, this is a major part that's lacking, unfortunately. Yeah, because they probably help you to calculate from year to year, but business structure or tax planning is not included in one of the focuses in financial planning services. All right, then let's have a look at different structures. So what's the pros and cons of different structures? Okay, under individual ownership, the pros or advantages will be, it's very simple. is easier to manage, all right? And then you have complete control of the assets or investment. And then under individual ownership, you do have the capital gains tax discount of 50%. Okay, then the accounting fees you're paying for tax returns or bookkeeping, or if you do have any income or deductions, or if you have a sole trader, that's actually not expensive, okay, compared to other structures. All right, and then the disadvantages are income tax at individual marginal tax rates, and there are limited tax planning opportunities. Okay, so the top marginal tax rate, as you might already know, is 47%. Yeah, so it can be quite high. And then unfortunately, there are not many tax strategies or planning strategies we can utilize for an individual taxpayer. All right, so it's quite limited. And also assets are not protected from creditors. So if someone claims bankruptcy or they're sued by a third-party creditor, their assets, so all assets attached to their individual names, right away they are exposed. Okay, so it's they're not protected. All right, and then the assets are subject to any family court action. So that's when there's a divorce or family breakdown. Okay, all the assets are included as a part of the assets, okay, for the couple, and then subject to family court decision on the distribution. All right, and then impact on Centrelink payments due to income assets test. So we mentioned in some like previous sessions as well. If say someone has a rental property or has shares or investment properties attached to their individual names, because most of Centrelink payments are income asset tested. Okay, then the value of the investment of the assets or the income driven from the assets that will impact on the amount you receive from Centrelink. All right, and then the ability of family members to challenge estate plans. So it's a common misconception. People feel that if they have a will, then their estate or their assets will be distributed to the beneficiaries, but it's actually not the case. Okay, so it's easily contested, yeah, by other family members. If someone had a divorce or even had a de facto relationship before, an ex-spouse can contest the will, okay, within 6 months, and then they can actually get the family court to distribute them with a part of the estate asset. It actually happened quite a lot. Yeah, there are many cases in the history. So that's something a lot of people don't know. All right, so that's individual ownership. Let's continue to have a look at company ownership. So company ownership, the pros are the tax rate is flat, okay, or flat for both types of companies. So 25% for an active business or 30% on passive income. So active business means that you are actually running a business and actively involved in the business. Okay, that's 25%. If you run a restaurant, say for an example, in a company structure, that's an active business. All right, and then of course base rate business, I think is 5 million. Also, it can't be too big. Yeah, so it's need to be based on the revenue. Okay, and only for small businesses or base rate businesses is actually 25%. And then for big companies, okay, above the base rate threshold on the revenue, or passive income. So passive income means if you have a rental property, so you don't need to do a lot to generate that income. Okay, basically just get the tenant to live there, or you have share investment, you only receive dividends. That they're all passive income. So passive income, the rate is actually 30%. Yeah, or it's actually for very big companies. Yeah, their company tax rate is actually 30%. All right, and then of course, as compared to individual tax rates, yeah, of the top rate, so 47%, it's actually much better. Okay, for the tax rate and the company structure. All right, then the control is based on the person with majority of the shares. Okay, of course, that could change in the event of divorce when there's a resettlement or redistribution of the shares from the court settlement. All right, and then future tax offset, franking credit on dividend payout. So of course, this is based on the current tax law requirement. Yeah, it happened a couple of times before that. Remember a few years back, in the last time when Labour Party tried to, during the election, they actually failed. They lost the election at the end. I think one of their ideas, it's actually probably offended quite a few people because they were thinking of abolishing franking credit. Yeah, so we never know. We don't know when it's going to happen again or whether it will happen again. But based on the current tax law requirement, there's a franking credit. So basically, what that means is the tax payment you made through a company structure is a little bit like a saving. Okay, so in the future, when you pay out a dividend yourself, it's similar to when you receive Telstra share dividends. Okay, there's if the company already paid tax on it, okay, you can actually receive it as a tax offset in your individual return. Yeah, so that's called franking credit. So you do have an offset yourself for private company as well. All right, and then a company has limited liability. So that means the risk of the shareholders is actually limited on the share investment. So if the company is not running well, so let's say, for example, it's going to be liquidated, then the maximum the shareholders are losing. Of course, we're only focusing on the equity investment, yeah, not including the loan they put in. Okay, so so their risk is limited on the share investment they put in. All right, on the equity side. So that means the liability, their risk is actually limited. Subject to actions against directors. On some rare situations, directors are still exposed. Okay, so say for an example, if the directors owe super for the employees or PAYG withholding tax to tax office for the employees' payroll, okay, or if the company is already insolvent, the directors are still trading, then in those circumstances, their personal assets still be exposed. Okay, the government actually chase them for the outstanding debts related to the scenarios I mentioned. Okay, all right, and then the disadvantages of a company structure is very difficult to get income out. Okay, so only accelerate dividends. And then if you get too much money out, it could trigger Division 7A issues. Okay, so also there are limited tax planning opportunities. Okay, because the profit can only be distributed to shareholders. And then also profit distributed to individual shareholders on personal marginal tax rates after franking credits. Okay, so even though franking credit will help you, but it can only help you to a limit. Okay, and then company structure is the only structure that doesn't provide the 50% discount on capital gains tax. Okay, and then that's when if you own a property for more than 12 months, okay, if it's attached to your individual name or family trust structure, you can actually receive a 50% discount on the capital gains tax, but a company doesn't have that discount. Okay, and then the company structure compared to individual taxpayer or a sole trader structure, the operating cost could be high as well. Okay, so on the tax accounting fees and also professional advice. Okay, for the example, Division 7A is actually quite complicated. So the advice could be expensive as well. And then your personal assets could still be exposed. Okay, if the creditors are after the directors, in those scenarios I mentioned earlier, the personal assets of the directors could still be exposed. Okay, and then the assets in the company could be exposed as well if the creditors are after the shareholders. So this is something important. So let's say, for an example, if this is a common scenario, if you have some assets included in a company structure and you are actually owning all the shares, so 100% of the company shares are actually under your name. So if because of other reasons you are some creditors are chasing you for any outstanding debts, the company assets, because the shares are actually under your name, okay, so you're owning the shares, and through the shares you're owning the company assets. So assets in the company through your share ownership could be exposed as well. All right, and then okay, the assets could be subject to family court actions and could be tied up for years as well. So that's also related to the shares. Okay, if you have shares under your name, your company shares are included as a part of your asset and included in the family court actions as well. Okay, and then of course there are estate planning issues or succession planning issues, actually more here. If something happened to you, okay, if the person is the only director, if you're the only director, or you're only the only shareholder, it's actually happen quite often that private companies only have one shareholder, one director. Then what will happen if that person dies or become unconscious? Okay, then there's no successor director. Then the company is actually there's nobody running the company anymore. It probably will run down to the ground, or you have to go to court to find someone to be able to take over the company. All right, so it's quite risky if you don't have a director or successor director there to take over. All right, so that's a company structure. And then let's have a look at family trust ownership. All right. So with a family trust, the advantages are, okay, control is held by the appointor or trustee of the family trust. So you still have the control, okay, through a different way, okay. And then family trust is probably one of the structures that has a lot of tax planning opportunities, okay. So income and capital gain can be distributed to family members. You can actually pick and choose which family members you want to give how much, okay, capital gain or franking credit, okay, it's called income streaming. So of course there are recent tax law changes, under 100A, but that doesn't change the fact that family trusts still provide us a lot more tax planning opportunities. All right, and then with the family trust, because the distribution, or when there's a capital gains tax, because capital gain is ultimately distributed to individuals as beneficiaries. Okay, so there is a 50% discount as well. Okay, so you're not losing that discount under family trust structure. And then the assets are protected from creditors as well inside the family trust. So the main reason here is because let's say someone is the beneficiary of a family trust, but that person is not owning the assets under the family trust. Okay, nobody is having the real ownership. Yeah, they're only benefiting from the assets. So that's one of the main reasons why the assets in the family trust can be protected, right? And then relatively more asset protection from family court actions. Okay, so of course, before there was a very almost like a perfect protection, yeah, for family trust, yeah, for family court actions. I think it was 2008. There was a case. Yeah, forgot the name. Yeah, but basically the case changed everything. Yeah, so because when the case happened, a family court, the court actually deemed the asset in the family trust when someone has direct control of the assets, okay, like as the appointor or trustee, then the assets can be included as a part of the couple's income, okay, to be settled under the court. And so that was a major change, but of course it still provide very good protection. Okay, so because it's only the person who's controlling the assets that could be disposed. So in some scenarios, let's say for an example, parents when they want to give some assets to their children, instead of giving them through individual ownership, yeah, they can actually include the assets in the trust and then just nominate their children as beneficiaries. Then, of course, when their children are not controlling the assets, then if the children are married, then their future spouse or their past, de facto relationships, they have no ownership or they can't really reach into the family trust when there's a family breakdown. All right. So, of course, as a general scenario, that's also based on the current requirement. I'm not a lawyer, so it's only a general advice. Yeah, this is based on my limited understanding. But of course, when you have a particular scenario, talk to us. And then if there's anything that I'm not certain, we will seek help from our solicitors, okay, or lawyers with special expertise. Okay, then for family trust is actually great for asset protection purposes because the holder of the assets is the trustee, not individual beneficiaries, yeah, as mentioned earlier. Okay, this could subject to scrutiny depending on who holds the shares of the corporate trustee and also who is controlling the trust. Okay, so the main thing what we'll drill down to at the end is who is the controller of the trust, and that controller is also controlling the trust asset. Okay, that's the main thing, right? And then okay, possible leading member trust could help with estate planning. So this is a concept. Of course, we have to give credit to Lightyear Dogs, Grant Abbott from Abbott and Morley Lawyers. So we actually learned a lot from him. Okay, he's one of my best teachers, I have to say. So leading member trust is actually a concept that when a family trust, you just nominate one key person, say maybe at the beginning could be the father of the family as a leading member. So that leading member will be the appointor or the first appointor and then the first trustee director. All right, then after the first person, if something was to happen to the first person, then another family member, maybe the mom, will take over right away. Okay, then after the mom, there can be another successor. So it's a little bit similar to if you think about the, in Britain, okay, the royal family, how the family is passing down the kingdom. Okay, that's a little bit similar. So you nominate, you find someone next in line, and then pass the trust or the controlling position to that person, and then that will make sure that the asset will stay within the family, and then also if someone dies or someone get mentally incapable of managing the trust or unconscious, and then someone else will take over right away. All right. So that's the whole concept of a leading member trust. All right. And then what are the disadvantages? Okay, so it's very complex. Okay, family trust is probably one of the most complex structures, yeah, out of all the businesses or ownership structures. All right, and then also loss is trapped inside the trust. So let's say, for example, if someone wants to keep a rental property within the trust structure, the rental property might give the family loss, tax loss, but loss is actually trapped inside the trust. If the rental property was attached to an individual name, that individual can actually utilize the loss to reduce other income, to reduce his tax. Okay, but if the rental property is inside a trust structure, you will have to stay there until in the future when the trust start to generate a tax profit. Okay, then the loss can be used to reduce a future profit or reduce future tax. So that's one of the major disadvantages of a family trust. All right, and then of course, undistributed profit in the trust is subject to top marginal tax rate of 47%. Okay, so that means in a family trust structure, we have to distribute all the profits, okay, as much as we can. All right, and then or of course, in some scenarios, family maybe after the distribution, so the family members, everyone's tax rate is already reaching 47%. Okay, then potentially we have other ways to deal with it. Yeah, maybe like say a bucket company. But yeah, this is one of the major disadvantages. So we have to distribute all the profits. All right. And then there are restrictions to distribute to minors. So minors, if they're under 18 years old, for anything above $416 distribution to them, yeah, the tax rate could be penalizing. Okay. All right. And then also the recent tax law changes. 108 is changing the current distribution rules as well. Well, yeah, if you're interested, contact us and then we'll give you more details. Okay. So, and then also when you are distributing something to a beneficiary, that beneficiary actually, they do have the legal ownership of the distribution. So it happens before that, let's say, for example, parents can distribute to their children. Okay, if they're above 18, they can actually, because they pay tax as an adult. So the first $80,200 will be tax-free. So it will help the family to reduce tax by quite a lot. But once you include the distribution in the family trust, okay, the children actually, they do have legal ownership of that distribution. So if the parents don't pay out to them or don't give it to them, they can actually sue the parents or sue the family trust to claim their share. All right, so that's something important. Okay, and then okay, there are more possible future scrutiny from the government and ATO. Yeah, this is mainly because family trust structure, everyone know is a great tax saving vehicle. Okay, and then that's why, yeah, the government is always going to be targeting family trust and change the tax law, yeah, to limit the flexibility, yeah, because ultimately the government want to make sure that there's a fair system, yeah, to for people to pay tax. All right, and then asset in family trust can be included in the asset tax for Centrelink payments. So that's mainly related to the controlling person. So who's actually controlling the trust asset, yeah, like what we mentioned before, the appointor, or the trustee or trustee director. All right, they are all potentially the can control the trust asset, and then if someone's in a controller position, then Centrelink tend to include the trust asset in the Centrelink evaluation, on the asset test. All right, and then income distributed to individual taxpayers is subject to marginal tax rates. This could drive tax rate to 47% if there's no bucket company. All right, bucket companies are more like a company beneficiary that can utilize the company tax rate. We will not go down too much details here, but that's that could be one way to tackle this problem. Okay. All right. Then next one, let's have a look at self-managed super fund, or SMSF. Okay, so the advantages are so SMSFs are family funds. So basically, they're built for many generations and designed for the last multi-lifetimes. Okay, with the SMSF, the trustee should be looking at providing retirement income and estate planning for the family, not just one person. Okay, two main purposes of SMSF. One is retirement benefits. One is estate planning for the family. All right, and then the trustees of the fund have control of the fund. Okay, and then there are a wide range of investment choices. Okay, inside of SMSF. You can potentially you can borrow money as well. Borrow loan for your investment too. And then assets are protected from creditors. So SMSF is probably one of the best structures. That's actually for asset protection. Okay. Then similar to superannuation funds, SMSFs are favorably treated under the Social Security laws. So under age pension age, or until age pension age, they're treated as exempt from the asset test. So after the age pension age, they form part of the member's asset test. So that's when we're considering, Social Security or mainly payments from Centrelink. All right, and then a large range of options on this and a wide variety available when it comes to providing retirement income from the fund. Okay, so there are many different options here. And then assets within SMSF are protected from the trustee in bankruptcy. That's what I mentioned earlier on the asset protection. Okay, once retired lump sums received by a member are protected. Okay, so but pension income form part of the bankrupt estate. So retirement lump sums received by a member are protected. So even someone, if they receive lump sum from their SMSF, even though they have claimed bankruptcy, that lump sum is still protected. All right, and then there are a wide variety of tax effective options that can be tailored to meet your specific needs. With our tax planning services, once we have self-managed super fund included in the picture, we can actually add a lot more, or different ways or more tax planning strategies that we can see a major tax saving. Okay, so that's with SMSF. The disadvantages of self-managed super fund. Okay, the law is very strict. Okay, mainly with SIS Act. Okay, so as a result, the trustee may need to consult a specialist advisor or auditor to make sure they understand the law requirements. Okay, so that they're in compliance. And then there are significant financial penalties for breaching the laws. And then based on memory, I think the worst case scenario, there could be a 4-year imprisonment, or sentence. If of course that's really worst case scenario, but so we need to be very careful with self-managed super fund. The trustee need to understand what are the legal responsibilities. All right, And then the cost of running SMSF could be expensive too, simply because it's actually involving a lot of legal tax knowledge. Okay, so if you want to run it properly, yeah, it's going to be quite costly. Okay, and then there's limited access to benefits in the fund. There are more advantages running an SMSF by yourself. So say for an example, if you have a temporary disability or temporary illness, you can't go to work, potentially you can get paid through your SMSF for a short period. Okay, and then so that's not provided by a retail super fund. Yeah, there are other differences between SMSF and retail fund. Yeah, this is one of them. But generally speaking, you can only have access when you retire, okay, or on compassionate ground. And then, so it's actually quite hard to get the money out. Yeah, it's not that easy on the general situation. And then benefits in a superannuation fund are part of spousal property and may be split in the event of divorce. That's with the family court, okay, with the family breakdown. All right. Then that's everything. Yeah, so I hope that's helpful. This is our contact details. If you have any questions, let us know. Yeah, give me a call, send me an email. Thank you very much. Okay. I'll talk to you next time.